What's up, guys? It's Nathan here. Governor Philip Lowe's decision to raise the cash rate to 3.85% was based on a number of key factors, and despite the criticism for the surprise, the hot jobs market, accelerated services inflation, rebounding house prices, and weaker labour productivity prompted the Reserve Bank of Australia board to increase the cash rate for the 11th time in this cycle. The unemployment rate at a nearly 50-year record low of 3.5% indicates a tight labour market, with an additional 53,000 people gaining employment since the Reserve Bank's board April meeting. The services inflation is accelerating at a 20-year high, with evidence from overseas suggesting that prices increasing for services are more persistent than initially anticipated. House prices have also rebounded since the Reserve Bank signaled a pause in interest rate movement last month. Although the Reserve Bank doesn't directly target house prices, higher assets contribute to high inflation as households feel wealthier and spend more money. The Reserve Bank aims to prevent home buyers from assuming that the rate hikes are over and consequently driving up asset values, further exacerbating the inflation problem. If you find value in these videos, please do me a little favor if you can hit that subscribe button. It does really help out the channel, and thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Another factor is the combination of solid nominal wages increases and weaker labor productivity growth, pushing up the real cost of labor and heightening risks of wage price being persistent. This lack of growth in the output per hour worked for 3 years has placed pressure on Treasurer Jim Chambers in the second budget to be implemented with real reforms that boost chronically weak productivity and alleviate inflation pressures. The Fair Work Commission has also been warned not to raise the minimum and award wages excessively from July, given the push for inflation matching pay rises by unions and the Labor government. The Reserve Bank of Australia also is taking into account the easing global banking problems in the United States and Switzerland, as the Reserve Bank previously was concerned about potential credit constraints slowing down overseas economies. Domestic inflation is not expected to return to the top of the RBA's 2 to 3% target until mid-2025, demonstrating a more tolerant and patient approach compared to foreign central banks. The Reserve Bank acknowledges that persistent challenges posed by inflation, which remains high despite passing its peak. Inflationary patterns in Australia resemble those in the United States, with initial increases in good prices due to pandemic-related spending and supply chain disruptions, followed by a shift towards services. As demand for services increase, so do prices for items like rent, restaurant meals, and airline tickets. Despite higher costs, consumers continue to spend their pandemic savings. The Reserve Bank and the US Fed worry that the businesses are raising wages to attract workers only to recoup the cost by increasing prices, and this could trigger a dangerous price-wage spiral. Lowe notes that service price inflation remains high and that unit labor costs are rising briskly amid subdued productivity growth. Lowe also must face additional challenges as he needs to account for the record surge in migrants entering Australia this year. While businesses hope this will alleviate labor market pressures and moderate wage growth, the 400,000 migrants will also increase demand, placing further strain on rental markets as well as potentially maintaining stagnant productivity growth. The Reserve Bank now states that further tightening of the monetary policy may be necessary to ensure inflation returns to within its target in a reasonable timeframe, depending on the economy and inflationary development. This stance is less hawkish than previous statement, indicating that the bank retains the option for additional rate increases, but may also conclude its rate hike for tightening cycle. Decisions moving forward will largely depend on the jobs market and inflation. Money market traders who previously priced virtually no chance of a rate hike are now less certain due to the Reserve Bank's messaging at Martin Place. As the Australian economy continues to evolve, these challenges that the Reserve Bank face will see them focus more on achieving a balance between controlling inflation and supporting the economy. The combination of higher interest rates, cost of living pressures, and early decline in house pricings has led to a significant slowdown in household spending. Although some households have maintained substantial savings buffers, others are experiencing a financial squeeze. The Reserve Bank will need to closely monitor this. And remember to like, share, and subscribe to stay informed with all things property and finance. The record surge in migration is also a key factor that the Reserve Bank's going to keep a close eye on. While businesses are hoping that this influx will alleviate market pressures, especially for labor prices, and the 400,000 people expected to enter this country this year will also potentially increase demand. Once again, with this heightening demand, it's likely to further put a strain on rental markets where vacancy rates are already at an all-time low. Additionally, a larger labor supply boost combined with relatively steady capital stocks may result in stagnant productivity growth. The Reserve Bank's primary objective is to return inflation to its target level without destabilizing the economy. The Reserve Bank faces a challenging road ahead in steering the economy towards a soft landing while ensuring that inflation returns to the target range. Its decisions will depend on the interplay of multiple factors, including the labor market, inflation, household consumption, global economic development, and migration. The Reserve Bank's resolute determination to return inflation to target levels will guide its actions, with potentially further more adjustments to monetary policy required, and it all depends on how the economy and inflation evolve. Did you know here at Hunter Galloway, we get mortgages approved? So if you're looking for assistance, looking to refinance, looking at purchasing your first home, reach out with us. Call us on 1300 088 065 or visit our website huntergalloway.com.au. Guys, as always, thanks for watching and we'll see you next time.